Hello and welcome to the third unit of Cost and Management Accounting. This unit deals with the subject of ascertainment of cost. The episode highlights the different methods of costing. I am Amrita Ghosh Kumar and the subject specialist for this episode is Dr. Taranum Amir, PhD in Marketing and currently teaching in Satyavati College, University of Delhi, New Delhi. Unit costing is one of the methods of costing, which is commonly used in dairies, paper mills, cement work industries, and so on. It is also known as output or single costing. Under this method, costs are ascertained as per the unit of a single product in a continuous manufacturing activity. Under unit costing, costs are accumulated and analyzed under various elements of cost, and the total of each element is divided by the total number of quantity produced. This method is used in those cases where the production is uniform and continuous. The units of product are identical and the cost units are physical and natural. The main purpose for using this method is to find out the cost per unit of the product. The cost per unit is found out by dividing the total cost during a given period by the total number of units produced during the same period. Number 1. Cost sheet. Cost sheet is a statement of cost. According to SEMA, cost sheet is a document which provides for the assembly of the detailed cost of a cost center or cost unit. It may be prepared weekly, quarterly, monthly or yearly. The main objective of cost sheet is to show the division of cost and to prepare estimates of costs for the future. There are two types of cost sheet, that is historical cost sheet and estimated cost sheet. Historical cost sheet is a statement of a cost prepared on the basis of the actual cost, whereas estimated cost sheet is a statement of cost prepared on the basis of estimates. The main benefits of cost sheet are: A. It shows the total cost of the product as well as the cost per unit produced during the given period. B. It helps the management in determining the selling price of the product. And C. It helps in cost control. Number 2. Production statement. The term production statement is defined as a statement which shows the costs of production, sales and profit made during a particular period. In other words, when cost sheet includes the amount of sales and profit, it is called production or output statement. Thus, we can say that production statement is an extension of the cost sheet. Number 3. Production account. When information contained in the production statement is presented in table form, it is known as production account. Number 1. A cost sheet is not based on double entry system, whereas production account is based on a double entry system. Number 2. A cost sheet shows different elements and cost of components in detailed and analytical manner, but the production account does not give detailed information about the different cost of components. Number 3. Cost sheet is more useful than the production account. Number 1. Stock of raw materials. In order to find out the raw materials consumed during a year, first add the value of the opening stock to the purchases of raw material and then subtract the value of the closing stock. In other words, opening stock of raw material plus purchases of raw material during the year plus expenses on purchases of raw material, that is the freight cost, minus the closing stock. Number 2. Stock of work in progress. The term work in progress means the units which are neither in the form of raw material nor the finished goods. It means the units which are still in the process of manufacturing. It is also known as semi-finished goods. Generally, work in progress is valued at factory cost, but sometimes it is valued at prime cost also. The treatment of work in progress valued at factory cost will be prime cost, add factory overheads, add opening work in progress and subtract closing work in progress. This will give the value of factory cost. In case if it is valued at the prime cost, the treatment will be direct material, add that to direct labor, add direct expenses, add opening work in progress and less closing work in progress. This will give the value of prime cost. However, it is always preferable to value work in progress at factory cost. Number 3, stock of finished goods. Generally, stock of finished goods is valued at the total cost of production. Thus, here the treatment will be total cost of production added to the opening stock of finished goods less closing stock of finished goods. This will give the value of cost of goods sold. According to SEMA, job costing is defined as a form of specific order costing which applies where work is undertaken to customer special requirement. Method of job costing is adopted by engineering concerns, printing press, repair shops, etc. Under this system, a separate job card or cost sheet is maintained for each job in which all expenses of material, labor, overheads are entered and cost of completing a job is ascertained. Such a system is also known as specific costing. Now let us look at the characteristics of job costing. A. Each job is unique and needs special treatment. B. A separate work in progress ledger has to be maintained. C. A distinct number is allotted for each job. D. Profit or loss is determined as per each job. What are the advantages of job costing? Number A. Determination of profit as per each job helps the management to decide profitable and unprofitable jobs. B. It also helps the management to determine the operating efficiency of the different factors of production. C. Spoilage and defectives work of a particular job can be easily identified. D. It also facilitates the preparation of estimates for similar jobs for the purpose of submitting quotations. What are the disadvantages of job costing? A. A lot of clerical work is involved. B. It is an expensive process. C. It does not facilitate control of cost unless it is used with standard costing or estimated costing. And D. It ascertains the cost of a job after it has been manufactured. The procedure for job costing involves a few steps. Number 1, job order number. Every order received from a customer is allotted a number. Throughout the production process, the job is known by this number. Number 2, production order. After accepting the job, a production order is prepared by the production planning department. This production order is a written order issued to the manufacturing department to proceed with the job. It contains all the information regarding production like an operation schedule, a routing schedule, departments and machines involved and so on. Sufficient copies of production order are prepared by the production planning department and are sent to the production department, stores department and the cost department. Number 3, recording of costs. The next step is to ascertain the costs of each job separately. Number 4, bill of materials. A bill of materials is also prepared by the production and planning department. It is required to complete a particular job. It is then sent to the storekeeper to arrange the required material for the job. One copy is sent to the foreman with the production order. Number 5. The job cost card. The job cost card is the most important document used in the job costing system. A separate job cost card is maintained for each job. The main purpose of this job card is to show all expenses regarding materials, labor and overheads. Number 6. Completion of the job. After completing the job, the production department sends a completion report to the costing department. On the basis of this report, the costing department completes the job cost sheet and calculates profit or loss on each job. A job ticket is issued by the production control department. This provides information regarding the progress of each job at each operation. It is useful for both production control and for the costing departments. On completion of an operation, the relevant portion of the ticket is detached and sent to the production control department. This enables the production control department in keeping production schedule up to date. On the basis of the detached portion, a departmental summary of production can be prepared, which is useful for costing purposes. The progress advice statement is a statement which provides information regarding the stage of completion of each job. It is sent by the foreman of a department. Batch costing is the method of costing where articles are manufactured in definite batches. According to SEMA, batch costing is defined as that form of specific order costing which applies where similar articles are manufactured in batches either for sale or use within the undertaking. A batch means the lot in which articles are to be manufactured. It is applied in those industries which are involved in manufacturing of ready-made garments, toys, televisions, watches and so on. The costing procedure for batch costing is similar to job costing. The only difference being that a batch becomes the cost unit instead of a job. Under this system, a separate cost sheet is maintained for each batch. Each batch is given a batch number. The cost of production per unit is ascertained by dividing the total cost of the batch by the number of units produced in a batch. Hence, a batch cost sheet is prepared. One of the most important decisions in batch costing is to determine the optimum size of a batch. Economic batch quantity is determined at the point where the total cost is minimum, that is, carrying costs and setting up costs are equal. Carrying costs includes the cost of storage, interest on capital, etc. Setting up costs includes fixed costs per batch. Contract costing is a special form of job costing. This method of costing is employed where big projects are involved and requires a lot of time to complete. In addition, if the work activities are to be done outside the factory like construction, shipbuilding, etc., contract costing is applied. The system of contract costing is very simple. Number 1, a separate account is opened for each contract in the general ledger. Number 2, the contract accounts are debited with all direct and indirect expenditure incurred in relation to the contract. Number 3, it is credited with the amount of contract price on completion of the contract. Number 4, the balancing figure is the profit or loss made on the contract and is transferred to the profit and loss account. Number 5, in case of incomplete contract, a reasonable amount of profit out of the total profit may be transferred to the profit and loss account. According to the Chartered Institute of Management Accountants, London, operating cost is the cost of providing a service. In other words, this method is employed by the service undertakings like transport corporations, electricity companies, canteens, etc. The method of computing operating cost is also very simple. All the expenses of operating a service for a particular period are grouped under suitable headings, and then their total is divided by the number of service units for the same period, and thus cost per unit of service is obtained. Process costing is employed in those cases where a product passes through different stages. It is suitable for those industries who are involved in manufacturing of rubber products, chemical products, medicines, etc. A separate account is opened for each process, and all expenses pertaining to a particular process is charged to that process account. Therefore, under this method, the cost of product at each stage is found. What are the advantages of process costing? 1. It is convenient and easy to compute the cost of different processes as well as finished goods at short intervals. Number 2. It is easy to apply standard costing because products and processes are standardized. Number 3. It is possible to allocate expenses to different processes on a rational basis. The disadvantages of process costing are: Number 1. The cost obtained at the end of the accounting period is of little use for effective managerial control. Number 2. If an error is committed in one process, it is carried over to the subsequent processes. Number 3. Value of work in progress is computed on the basis of estimates, which results in further inaccuracies. Number 1. Materials. The value of material issued is debited to the process account. In addition, when output of first process becomes the raw material of the next process, it is also debited to the process account. Number 2. Labor. Wages of the workers are also debited to the process account. Number 3. Direct expenses. Direct expenses like depreciation, electricity, etc. are also debited to the process account. Number 4. Production overheads. Production overheads are recovered at predetermined rates based on direct wages or prime cost. Thus, the process cost does not include office and administrative overheads and selling and distribution overheads. Normal loss. It should be charged to the goods unit arising out of the process. Thus, cost of lost units is absorbed as an additional cost of goods units produced by the process. There are 3 circumstances. A. In case scrapped units have some value, then the amount should be credited to the concerned process. B. In case the scrap is of a very small value, then it should be credited to the works overhead account. C. In some processes, a proportion of the output must be reworked either in the same process or an earlier one. The value of such output is not more than the value of crude materials to which it corresponds. The relevant process should be credited with the value of such crude material and should be charged to the process to which such material is related. Abnormal loss. Abnormal loss is transferred to costing profit and loss account. Procedure of calculating the value of abnormal loss is: A. Find out the quantum of normal loss. B. Find out the cost of production per unit of the relevant process after considering normal loss, assuming that there is no abnormal loss. C. Multiply the abnormal units with the cost per unit computed as per point B. This will give you the total value of abnormal wastage. D. Abnormal wastage account will be debited and relevant process account will be credited with the amount and quantity of abnormal wastage. E. The balance in the process account is the cost of goods units produced by the process. F. Abnormal wastage account will be credited in case any value of abnormal loss units is realized. G. Abnormal wastage account will be closed by transferring it to the costing profit and loss account. Abnormal effectives. In case the actual production is more than the expected production, the excess units are known as abnormal effectives. Number 1. Method of job costing is adopted by engineering concerns, printing press, repair shops, etc., whereas the method of process costing is used by rubber products, chemical products, companies, etc. Number 2. A job is the cost unit in case of job costing. A process is the cost unit in case of process costing. Number 3. In job costing, greater supervision and control is required. In process costing, comparatively less supervision and control is required. Number 4. Total cost of a job is divided by the number of units produced in the job to ascertain the unit cost of a job. In the case of process costing, total cost of each process is divided by the production of each process. Number 5. In job costing, there is no transfer of cost from one job to another, whereas in process costing, cost of one process is transferred to subsequent processes. Reconciliation is the process through which the profits of two sets of books, that is, the financial books and costing books, are tallied with each other. The main object of reconciliation is to find out the reasons of disagreement between the financial books and the costing books. Number 1. Items shown in cost account only. There are certain items which are shown in cost accounts but excluded from the financial accounts. Such items are notional rent of the owned building, depreciation on an asset even when the book value is reduced to a negligible value, interest on capital employed at notional figure even though not paid. All these items will reduce the profits in cost accounts as compared to financial accounts. Number 2. Items of income shown in financial accounts. There are certain incomes which are included in financial accounts and not in cost accounts. For instance, interest received on loans, rent receivable, profit on sale of assets, transfer fees, brokerage or commission or discounts received, dividend received, etc. Number 3. Items of expenses and losses shown in financial accounts only. There are many items of expenses and losses which are shown in the financial accounts only but not in cost accounts. For instance, financial expenses like interest on loan and debentures, cash discount, fines and penalties, goodwill, preliminary expenses, etc. are written off. Loss on sale of fixed assets and investments, donations, subscriptions, and so on. Discount on issue of shares and debentures are included in financial accounts only. Similarly, abnormal losses like abnormal wastage of materials, loss by fire or theft not covered by insurance, cost of abnormal idle time, etc. are included in financial accounts. Number 4. Valuation of stocks of raw materials, finished goods and work in progress. In financial accounts, stock of raw materials is valued at cost or market price, whichever is less, whereas in cost accounts it is valued at FIFO or LIFO or average method or any other method. In financial accounts, stock of finished goods is valued at cost or market price, whichever is less. In cost accounts, it is valued at the total cost of production. In case of financial accounts, work in progress may be valued after considering a part of the administrative expenses. But in cost accounts, it is valued at prime cost of factory cost or the cost of production. Reconciliation statement is a statement through which the profits disclosed by cost accounts and financial accounts are reconciled. Steps involved in the preparation of reconciliation statement are: 1. Reconciliation statement may be prepared either by taking profits shown by financial accounts or profits shown by cost accounts as base. For instance, if the profit shown by the cost accounts is taken, then all the adjustments will be made only to profit as per cost accounts. Number 2, now the reasons for differences between the profits as per cost accounts and financial accounts are identified. Number 3, suitable adjustments are made in the profits by additions or deductions. Number 4, after adjustments, one can reach at the profits shown in financial accounts. Profit as per cost accounts. Add incomes not recovered in cost accounts. Add costs and expenses recorded in cost accounts but not in financial accounts. Less costs and expenses not recorded in cost accounts. Add over-absorbed overheads in cost accounts. Less under-absorbed overheads in cost accounts. Less undervaluation of opening stock in cost accounts. Add overvaluation of opening stock in cost accounts. Add undervaluation of closing stock in cost accounts. Less overvaluation of closing stock in cost accounts. This is how a profit as per profit and loss account or a balancing figure will be arrived at. That is all for today. Hope you have understood the different methods of costing. We'll see you again with another topic of cost and management accounting very soon. Till then, take care and bye-bye.